Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So markets are now dealing with a new threat of tariffs on U.S. imports. Last Friday, President Trump declared a 30% tariff on goods from both the European Union and Mexico, effective August 1st. It was just the day before Trump threatened Canada with a 35% tariff. So markets have been somewhat well-behaved, as if they are counting on Mr. Trump to back down, having seen U-turns before. The question is whether that remains the best bet. In a moment, we'll travel to Singapore and speak with Bloomberg MLIV Strategist Mary Nicola. We begin in the States, though, as we look ahead to second quarter earnings. Joining me now is Rod von Lipsey. He is Managing Director at UBS Private Wealth Management, on the line from Washington, D.C. Rod, thank you so much for making time to chat with me. So earnings from a couple of the big banks are on the list this week. We'll also get numbers from TSMC and Netflix. I'm curious, how do you feel about the quality of the results that we're going to see for Q2?
You know, this is going to be a very interesting quarter-over-quarter, year-over-year look, in part because we go back just a quarter ago, and the whole tariff scenario really put corporations in a very strange place. The estimates right now on the street, we're looking at under 5% earnings for EPS growth year over year. We at UBS believe we're going to come in closer to about 6% when we look at 2025, and growing to, call it $265 a share on the S&P 500. I think that this busy week, you're really going to see some acceleration in the earnings reports. For Monday, Tuesday, Wednesday, the big banks really start to kick off on Tuesday. And our expectation is that those estimates are going to beat consensus. They're going to be pretty strong. In one case, because the higher interest rates, especially for financials, have been very, very supportive of NII and net interest income and net interest margin for these banks. So we'll see some good numbers there. And I expect that some of the economic activity has been pulled forward in this second quarter, especially since tariffs have been threatened and delayed and postponed. So lots of activity. But it's going to be a strange one, and everyone is going to be looking at not just the second quarter results, but what will be the forecast for third quarter and looking forward.
Before we leave the banks, I want to ask about whether trading revenue has the potential to be a real standout here, given the volatility that we had in markets in the second quarter, whether banks really benefited from that on the trading side.
Anecdotally, Doug, absolutely. And that's why we are not only sort of very, very bullish, if you will, on financials and the asset managers, because we think that trading activity in this second quarter was just off the charts, especially during April. And so with that pickup in activity, with all of that uncertainty and all of the activity that went around that, I think it's going to be a pretty strong, especially for the broker dealers, it's going to be a very, very strong second quarter.
We mentioned earlier the impact of the tariffs, and I thought it was very interesting. Last Thursday, we heard from ConAgra the outlook well below expectations, and the company pointed out that rising cost for tin plate steel used for food cans due to tariffs is going to have a very consequential negative impact. Is this something that's going to be more predominant when we talk about margins, just how this begins to manifest?
It's interesting. The UBS base case is that we're going to end up somewhere at around the 15%, sort of across the board tariff rate, and that the consumer is going to be asked to bear the brunt of much of that. And so that works into our economic forecast numbers. But the commodity prices, quite frankly, are just all over the charts because of the dramatic uncertainty. Most of our investors are focused on commodities like gold and oil and don't dig too far into the commodity indices. But when we look at commodities, they truly are really all over the charts, because it's very difficult to understand how the policy and the tariffs and the trade considerations will affect those underlying commodities. But I think it manifests itself, at least in our forecasts, on inflation that remains fairly pernicious and stays above the Fed's stated 2% target.
Interesting. And yet, with all the risk out there, we've got an S&P 500 trading at 24 times earnings. Is that a little bit of a head scratcher for you?
It truly is, because we have different things, especially if we look at our UBS macroeconomic forecasts. We see For example, GDP growth in the Americas for 2025, we're estimating 1.5% GDP growth, but we're looking at CPI or inflation. And can we have some releases this week that will tell us? But we see inflation coming in almost at 3% and actually accelerating into 2026. And that is directly because of this concern about how tariffs are going to flow through to the consumer and how they're going to keep inflation fairly high. Now, the markets seem to be unfazed by the tariff talks. The markets seem to believe that we're going to get to August 1st and either we'll have a favorable outcome or things will get pushed back again. And so they are completely unfazed, at least if we look at at all-time highs and continuing to be there. And so on a macro level, we think that this bull market that we've been experiencing continues to have legs. It continues to have momentum. But the real place to keep an eye out is going to be the bond market. Because at some point in time, a lot of the things that were in the big, beautiful bill, a lot of the things that are coming into the economy because of increasing tariffs, at some point in time, the bond market is going to give us a signal. And that's really where we have a cautious outlook.
So if you were going to be in the fixed income space, where do you want to hide out? The belly of the curve, or do you want to be maybe more exposed to the short end? What's the strategy?
Listen, we think that in the belly of the curve, and we think that on balance, again, with our forecasts looking 1 year out with 10-year rates coming back down to 4%, we think that the bond market provides an opportunity for the long-term investor. These are actually attractive levels, especially when you look at spreads for high-quality municipal bonds for taxable investors in the U.S. or corporate bonds. We're seeing an opportunity there to get nice returns, but that does not mean it's not going to be volatile in the short term. And that's the real challenge for the bond investor, is to take a look at it, pick your yield, say this is the yield that I think is going to work, and recognize that next week, next month, that might feel like a bad decision, but by next year, you'll be glad that you're sitting on that high quality paper.
Does the big, beautiful bill at any point in the future begin to negatively impact the muni market, particularly at the state level?
Well, that's a fantastic question. And I think that has been structurally appears to be something that's being pushed down the road a little bit. Doug, I've got to say that I have not read The Big Beautiful Bill, and I don't know very many people who have actually been able to read that book cover to cover. But it's my understanding that much of the good news has been baked in and takes immediate effect. And then some of the ways to pay for that good news have been pushed back, some of it beyond the midterm elections. And so that is going to create some challenges. It's going to create pressure for things that are being put on states and municipalities. There's been a lot of bond issuance, especially by municipal issuers there this year to try to get out in front of this before rates potentially go up. So yes, I do think there's some challenges that'll be ahead, but I don't know that those are near term. I think those are pushed into 2026 and beyond.
Okay, fair enough. But I'm wondering whether or not, given everything that we've been laying out, that you're tempted to look a little offshore right now to remain diversified. Do you want to look at foreign markets?
Our investors have been clamoring to understand ways to diversify against either monetary or fiscal pressures and challenges here in the U.S. And so, listen, that's why we're seeing gold prices in the current range. But we're also seeing lots of great performance out of the international markets. I think one of the questions is whether the international equity markets, especially the Eurozone, whether it's fully caught up or is there more room to grow. We think that selectively looking offshore, holding foreign currency, holding gold, that those are nice hedges. But when it comes to actually making an investment that'll outperform the U.S. markets, that becomes a little bit more of a murky question. Very, very difficult to us to look at European equity market growth and U.S. equity market growth, especially when we look at the focus of IT and financials here in the U.S. And believe that there's a lot of room for outperformance there in the developed international markets. Emerging markets, both on the debt and the equity side, do show some green shoots and do show some very, very strong either sovereign balance sheets or good positions for these corporations. But the path of tariffs will really, really make a difference. And so that makes it a little bit of a challenge for U.S. investors to go too deeply and go too far, either out of dollar investing or into international equities.
House Republicans have declared the week ahead as crypto week, and I'm curious to get the take from the private wealth management perspective. How is the cryptocurrency space viewed? Is Bitcoin something that represents opportunity, or do you see it pretty much as kind of noise around the edges of what the market is involved in these days?
Boy, that is a really challenging one. It's also very challenging for someone in a broker-dealer, especially a big firm facing the Fed, to really understand the path and the fate of cryptocurrencies. I think 3 points, though. One is that these are certainly with us, and they're going to stay with us. I do believe that there are many of the cryptocurrencies themselves that are highly speculative, and we are now starting to see a number of stable coins that are actually buying treasuries and basing them on treasury. And so one of the interesting dynamics that we're seeing in the stable coin or the crypto assets is the purchase of treasuries. Which is, if you had sort of thought about it initially or off the cuff, you would think that the crypto or emergence of more crypto options would actually be a move away from treasuries, when in fact the underlying securities and the underlying issuers are actually buying treasuries to make sure that they get that stability. So I think that it's going to be a very, very interesting thing. Obviously, there's administration and on the Hill, there's support for crypto assets, but we continue to look at them as being highly speculative.
Okay, we'll leave it there. Rod, thank you so much for joining us. Rod von Lipsey there, Managing Director, UBS Private Wealth Management, on the line from Washington, D.C., here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So we know last Friday, President Trump declared a 30% tariff on goods from both the European Union and Mexico. They are effective August 1st, unless there is some sort of trade deal with both jurisdictions. Over the weekend, we heard from Ursula von der Leyen. She is the president of the European Commission, and she said the EU will extend the suspension of trade countermeasures against the U.S. until August 1st, and that, in fact, will allow for further trade talks. We also heard from Mexican President Claudia Sheinbaum. She said that her team had already begun discussions with the U.S. on Friday. Joining me now for a closer look at the tariff story is Mary Nicola, Bloomberg MLIV Strategist. Mary joins us from Singapore. It's always a pleasure to chat with you. I'm curious as to get your take on the tariff headwinds where you are and what's being said about whether President Trump may be bluffing.
Yeah, I think that is very much the case, especially if you saw the way Asian equities had reacted last week, and it looked like they were shrugging off a lot of the noise that was coming through on tariffs. They shrugged off the noise on 50% on Brazil. Obviously, this morning, Japanese stocks are down, but actually, if you look at the Kospi in Korea, that's holding up quite well. So there has been this disparity in terms of they're shrugging it off because doors are still open for negotiations, and I think that's key for market. And also the fact that we could potentially see President Trump backpedaling. Also, the fact is that the data is holding up quite well. So I don't think you'll start seeing cracks coming through into markets until we actually see some of the data come through fruition, or the fact that you're seeing weakness coming through. And because we haven't seen that, it looks like, the markets here in Asia are holding up relatively well.
It's interesting. Tonight here in the U.S., we had Trump saying that South Korea wants to make a trade deal. Now, that's coming from Mr. Trump's perspective. I'm not so sure that the same thing could be said for the South Korean side. Isn't it really difficult to kind of get a sense of where we are in the negotiating process?
Yeah, it's interesting too, because if you look at Korea, the US has a free trade agreement with Korea. So obviously the building blocks are solid and they're already there, but it's a matter of what more is the US looking for? And I think that keeps coming up, especially in negotiations. So, for example, with Japan, you've had a setback because of agriculture. Agriculture is always a key sticking point when you're discussing trade negotiations and trade agreements, because obviously agriculture is considered some sort of national security issue as well. And then but for Korea specifically, it's interesting because you do have solid building blocks. You do have a free trade agreement. But of course, it's a matter of the 25% tariffs on cars. That's obviously a key sticking point for the Koreans, and they want it to go away because obviously cars are a big part of what they're sending and what they're selling to the US. So unless those sectoral tariffs, which are still some of the bigger issues, go away, I think that might still hold Korea back and hold off an agreement between the two nations.
So I'm curious, Mary, as to whether or not we have any data, high frequency or otherwise, that might give a little bit of insight into how this trade war is impacting not only Japan, but South Korea as well, economically. Do we know anything?
Yeah, so far, actually, if you look at so Korea, for example, releases export data 10 days, 20 days. And then also if you look at the current account data, actually, all of them have been quite solid. So that's another key reason as to why the Asian markets have been holding up relatively well. Not to mention the fact that China as well has been holding up relatively well as well, in addition to that. So, but if you look at some of the trade data coming out of Korea, there's no real indications that there has been a real slump. And that's really helping a lot of the markets. And I think as long as you see the strength in the current account, the strength in the external sector, that's going to keep equity markets, at least in the region, robust.
So I know we get a couple of key data points for the Japanese economy this week: machine tool orders, industrial production. I think there's some inflation data in there as well. What are you going to be looking at?
Yeah, I think the main thing for investors right now for the Japanese economy is on CPI. Obviously, there's a lot of concern about inflation. There's a lot of concern about because especially we're seeing yields rise. And there's this toxic mix for Japan, whether you're seeing it because of quantitative tightening, whether you're seeing it because of inflation, whether you're seeing it because of worries about fiscal profligacy, and especially with the elections coming through and the potential for more fiscal spending. So there is really the heightened focus is on CPI. Is CPI still high? And of course, we know that the Bank of Japan has been quite reluctant to hike rates. So real rates remain quite high. And as a result, I think you're seeing investors just incredibly wary of especially Japanese bonds. That's also going to weigh on the yen in addition. So I think the focus for investors this week is going to be not only on CPI, but also on the elections.
So is the BOJ in a little bit of a bind here? I mean, if there is upward pressure on price action, or to say upward pressure on inflation, and the risk of more economic slowing, I mean, how do you engineer your way out of that?
Absolutely. And that's a really good question in terms of what do they do? And so far, they've sent a message that, especially on the tightening side, that they're sitting on their hands. They're weighing what is happening externally. They're concerned more about the external challenges and the implications on the economy than inflation. And that has actually been to the detriment of the Japanese bond market and will likely hurt the yen as well. But in the meantime, we are seeing quantitative tightening. And it's interesting to see the bond market reaction that despite the tweaks they've made, so for example, the Ministry of Finance has already decided to reduce issuance in the back end. And we've seen some of those tweaks, yet we're still seeing pressure on bonds. So it's almost like they've let out their tools, but the tools aren't working. And that's just very much indicative of the bind that they're in. And of course, adding to that is just the potential of fiscal expansion, and that will just only add to the pressures on the bond market.
So I know, based on our history of conversations over the last several years, you pay very close attention to what the Fed is doing. And we've got President Trump and some of his allies who have been very critical of Fed Chair Jay Powell's handling of some of the renovations being done at the Fed headquarters. And a few people in the administration have been now building the case to remove Powell from the Fed's Board of Governors. Were that to happen, it's probably a very extreme type scenario. What would the reaction, do you think, in Asian markets be under that scenario?
Yeah, I think it's actually still a very dangerous game to play where you're potentially cracking and ruining the credibility of the Fed. And that's essentially what's been happening with all this pressure on the Fed. Where you do see is a potential reaction is that a move and a shift away from the dollar. And that actually could be beneficial to a lot of the Asian currencies. We've seen the dollar slowly decline, actually more than slowly decline since the start of this year. And I think that just precipitates it. And what you'll see is a switch over to a lot of the Asian currencies, for example, the CNY, the Korean won as well, where they are likely to get a bid as a result because of the fact that, there is just this loss of credibility. Because if you do put someone who is in that is complies with what the fiscal policy and what the administration wants, that just risks where we could see inflation and how potential monetary policy just gets out of control. So I think in general, what you'll see is just that shift continue away from the dollar as a result if you see further cracks in the Fed's credibility.
Mary, we'll leave it there. It's always a pleasure. I hope you have a productive week in the Lion City. Mary Nicola there, Bloomberg MLIV Strategist, joining from Singapore here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.